Good afternoon, everybody, and welcome to our virtual conference discussing the other yellow metal, uranium. We hope that you and your families are well during this time, and we thank you for joining us today. To stay up to date on all our upcoming webinars and see the replays of past webinars, including this one when it's over, check out our brand new Red Cloud's brand new news and media page. Josh will post the link to it in the chat. My name is Derek McPherson. I'm the Vice President and Equity Research Analyst at Red Cloud Securities. Just as by way of note, we started digging in the uranium market just over a year ago. A gentleman on the call with me have been doing it for far longer. But the conclusion that we came to was for the future uranium band to be met, the price had to go up. And we published our most recent update on the uranium market in general and the longer term fundamentals just over a week ago. However, in the last few days, that's all changed with COVID-19 related mine closures pushing the market. So this has, so yesterday we published a piece on that as well. So and Josh will put the link up for that. So lots of uranium focused research coming out of us, and we're really getting bullish on the uranium market at Red Cloud right now. I have with me for today's webinar, Ross McElroy, President, COO, and Chief Geologist at Fission Uranium, Daniel Major, CEO of VX Uranium, and Corey Diaz, CEO of Anfield Energy. So for today, I'll give a brief overview of the uranium market and where we're at, kind of a summary of our recent research. Each presenter will have about 10 minutes to go through their presentations. We'll take questions live from the line for 5 minutes on each company. And then at the end of the presentation, we'll take questions and everyone will answer on the state of the uranium market and where things are at. As a reminder, if you do have a company specific question that you're asking or a market specific question, it would be helpful if you put that when you type your question in, you put the company's name beside it. Otherwise, I might ask it to the wrong company or ask it to all three by accident. So, and then after. Just as a way of note for order, after my intro, it'll be Fission, VX, and then Anfield. To get the disclosures out of the way, I'll go through that first. For all three companies, there may be forward-looking statements made on the webinar. I would direct listeners to the cautionary note on page 2 of each company's corporate presentation, and those presentations can be on each company's website. And then for Red Cloud Securities Inc., I would highlight this webinar is for information purposes only and should not be considered a solicitation to purchase or sell securities or a recommendation to buy or sell securities. We note that this call does not take into account the particular situation or needs of individual investors. Participants should rely on their own investigations and seek their own professional advice before investment. And for company-specific disclosures on each company, please see our recent research on each company for those disclosures. So now, Josh, if you could put up my presentation, that would be great. So, for my basically what we've seen is there's growing supply deficit for uranium, and that's just being accelerated by the recent shutdowns. If you look back for the last month or so, this is what it looks like, and this is a great looking chart if you just started looking at the uranium space. Obviously, on March 23rd, Cigar Lake shut down, and then Namibia shut down their operations. And then obviously yesterday, Kazatomprom Kazatomprom had to restrict their production. And so effectively you have this big push on the spot price that's providing momentum. And we've seen the equities trade well with this as well. Now, you have to remember though, that in the context of where this is in general, still a long way to go. I think I put the Cigar Lake flood on there from 2006 back up on the slide. And the reason for that is that really drove the uranium price the first time around. And while history doesn't always repeat, it does rhyme, and it seems like Cigar Lake might be the shutting down of Cigar Lake might be the catalyst to push the uranium market back to where it needs to be. I think we've reached a situation where fundamentals favor producers. The spot market is tightening. It was tightening before the COVID-19 related shutdowns, and now it's getting worse. From Cigar Lake, Husab and Rossing, you have 2.2 million pounds a month currently offline. We don't know when those will come back, but right now they're taking 2.2 million pounds a month out of the market. Kazatomprom is guided for 2020 production to be 10.4 million pounds lower. So a substantial piece of the market. You're talking about, probably 6-7% of the market has come offline, give or take. We know that Cameco has to be in the market buying 20 to 22 million pounds, plus what they've lost from Cigar Lake being shut down and their joint venture with Kazatomprom. So obviously they have some material to buy, and Kazatomprom has guided that they weren't going to sell in the spot market, and their flexibility to do so has come down. They had planned, they had 25 million pounds in inventory at the end of last year, and so that inventory is now being consumed by their shutdown. So obviously they're not necessarily a seller. So the spot market is tightening, which is going to force producers to be a little bit desperate, and then also, but also could push them back into the long-term market. And that long-term contracting is important. And the biggest group of the long-term contracts is actually the U.S. utilities. And the UXC in their last report put out this chart. They broke it down by region for the first time, and I think this is really important. For the United States, 37% of U.S. utilities demand is uncovered for 2022. That's 2 years from now. If you're signing a long-term contract today, that's when you get material delivered. And that's a significant amount of the market. 17 million pounds or 9% of global demand. And so these utilities need to contract now to meet that demand. And we already forecast a 31 million pound deficit in 2022. So if you want to secure supply, you need to be at it. And I think what the COVID-19 related shutdowns are showing just how tight the market is and how hard it is to get supply if you need it. And so, this is our supply demand balance model and what we see in the market going forward. And 2020 is just the black bar there. And 2 weeks ago, that was basically break even. We had forecast probably about 200,000 pound deficit. And now we're at sort of 12.8 million pounds and growing. So that is significant. And that's not something we were expecting until 2024 when some mines, they're scheduled to shut down in 2021 and 2022 came offline. So that is impressive. And you have to remember that despite all the shutdowns and the economic slowdowns, uranium generally represents baseload, and that baseload, that uranium demand for 2020 hasn't really changed. And this chart summarizes our view on the uranium market and why it must rise. It's probably the key to our thesis. This is a 2030 forward-looking cost curve. The red boxes are mines that are offline right now and what they're set at the incentive price to turn them on. The white boxes are mines that are online, that were currently online, or I guess online pre-COVID-19. And the two key lines on this are the vertical line. So the vertical red line are mines that are economic at the current long-term incentive price. And that gap to the black vertical dotted line that's the mine supply that is needed in 2030. And so everything in between needs to come online. And for everything in between to come online, the price has to rise to get the incentive price and the financing to build those mines. And so it really is the key to our thesis, and that's why we're bullish on uranium. So what is going to push the uranium price higher? Well, we're already seeing it. The COVID-19 shutdowns are pushing the spot price higher. It's going to be pushing up against the long-term price very shortly. If we get more of those or the duration increases, I think that will continue to provide momentum. Of the mines that could shut down, the one that's probably most notable is Olympic Dam. It's 9 million pounds a year, but it's unique in the sense that a lot of its uranium goes into the spot market. And so taking that 9 million pounds out of the spot market could be a significant catalyst for the price. And the other thing that's important, and it may take to the end of COVID-19 to actually happen, but the Section 232 Nuclear Fuel Working Group saga needs to come to an end. And the key thing there is, more importantly, is that the U.S. utilities get free to enter the long-term market. They know what restrictions they have on what they buy. But the other thing there is obviously the strategic reserve, which will favor U.S. developers like Anfield, since it's basically going to consume all U.S. mine supply. It would consume all U.S. mine supply the way it's proposed right now. And so is it time to add uranium exposure? Obviously, there's been a big move in a lot of the equities. You could see here, we've broken this down by category of investment and then a different time period. So the gray line is since March 23rd, i.e. since the first shutdown was announced. The black line is since February 27th when we started to see sort of COVID-related liquidity selling. And the red line is the 1 year performance. A lot of these stocks are still under significant pressure. The uranium price, as we said earlier, has a long way to go to get back to being economic for a lot of producers and developers. And so I think we're in the very early stages of a run. And just because you weren't invested on March 23rd doesn't mean you've missed it by any means. So with that in mind, we will take it over to our first presenter. So our first presenting on behalf of Fission is Ross McElroy, President, COO, and Chief Geologist. Ross.
Good morning. Well, let's start right in. Thank you, Derek. That was I think an excellent introduction to the market. Fission's certainly participating as well with all our other players that, significant increases in the share. In just the last 3 weeks, we've seen an increase of, well, probably 200% from our lows. We were trading, I think, March 23rd, 9.5 cents, and now we're, 22 to 25 cents, somewhere in that realm. Just quickly here, if we're looking at the highlights of why you want to keep your eyes focused on Fission, these are some of the key factors. And certainly we have an award-winning management team. This group has won pretty much every award available in the mining sector for its discovery of the R deposit at PLS, but also we've been able to perform. We've been able to monetize assets. We've made other discoveries in the past and sold. So, I think we've got a pretty good track record. This group knows what they're doing. The PLS project is located in the province of Saskatchewan, which is it's in the top 10 and probably in the top 2 or 3 jurisdictions recognizable worldwide. Certainly, probably one of the best jurisdictions in the uranium sector. The R deposit is similar to other Athabasca deposits in that it's large, it's high grade, but something that we have that none of the other competitors have is the shallowness to surface. In other words, the deposit occurs very close to surface. That will work in our favor for being, taking a lot of the technical risk out of mining it down the road as well. So that's a huge advantage that we have over pretty much every other high-grade large deposit in the Athabasca Basin. And as you'll see, we have a lot of untapped exploration potential yet on this very large 32,000 hectare ground of the PLS in the southwest side of the basin. I won't get into talking about the team again. I've already mentioned them, but this is a serially successful group, and we've been long in the game, and we'll continue to do so. Our history dates back to 1996. We've had a few iterations of Fission. We've sold various assets. Currently, it's Fission Uranium Corp, and our sole and only asset is the PLS project in the southwest side of the basin. So if you just look at the top 5 uranium mining jurisdictions in the world, you can see what sets Canada apart is the grade of the deposits. So number 1, you've got strong jurisdiction, you've got grades of deposits that are orders of magnitude higher than anybody else, and a very long history of successful, uninterrupted uranium mining. Now, I suppose this would be the first year that I'm aware of in that entire 60 to 70 year mining history where there is no production in the Athabasca Basin, and that is a result, obviously, of the COVID-19 coronavirus situation, where now the last operating mine in the Athabasca Basin, Cigar Lake, is on temporary shutdown. So, however, these are extremely high quality deposits, and we fully expect the Athabasca to reassert itself as a very, very strong top producing uranium district. Where we're located here, you can see the map of the Athabasca Basin. We're located in the southwest side of the basin. When we made our discovery back in 2012, we really opened up a brand new area for discovery. Nobody had thought to look to any great degree for anything out in the Southwest, because the last 50 years there's been mining on the eastern side of the basin. It's just we took a new look, found some new area, made a discovery just outside of the basin margin itself, and our discovery spurred NextGen to start looking, and right next door on trend they made the discovery of the Arrow deposit. And then the Cameco Orano Pierpoint joint venture, the next project in line along that trend, made another discovery called the Spitfire. So it's really starting to look like the southwest side of the basin is becoming every bit as important as the eastern side of the basin. And in fact, I think that it is truly the next generation of mines will be developed from the southwest side of that area of the basin. This is just a close-up of the PLS project. As I mentioned, we've got about 31,000 hectares of land. That's a quite an extensive area. Just for comparison's sake, you can see the island of Manhattan. Our project area covers 5 times the land size of Manhattan. Those red dots that you have up in the north central part of the project area, that is the Triple R deposit discovered in 2012, and where we've been working to advance, which we've just completed our pre-feasibility studies in 2019. So we have a great deal of untapped ground yet to explore, and that'll be part of the focus over the next several years, as well as developing this project, the Triple R deposit, as we move it towards eventual production. Just looking at some of the other projects in the basin, just to give some relative context for where we sit. This is a depth scale, and you can see the Triple R deposit, the third bar from the left. This is a depth scale showing where the deposits actually occur. So our mineralization starts at 50 meters below the surface and basically goes down to about 300, just over 300 meters. Compared to other deposits, Cigar Lake was down around 400 meters, MacArthur around 600 meters. The other guys are significantly deeper. The one takeaway I look at this map is you'll see it in almost every mining jurisdiction, but generally the closer a deposit is to surface, the more likely it is to get moved up higher up in the queue for mining. There's lots of reasons for it. Generally less expensive to mine the closer it is to surface, and also lower technical risk. So that's one of the advantages we have. This is a cross section showing the mineralization along our 3.2 kilometer mineralized trend. The real, the bulk of the deposit, of course, is the R00 and the R780. That's where we have over 100 million pounds outlined, and where we've done our pre-feasibility studies. We completed one last April that looked at this as a open pit and an underground hybrid mine. We thought best to consider this as an underground only operation, so we did a second pre-feasibility study, and from every metrics that we look at, this project seems to do much better as an underground only operation. Much smaller capex. In fact, I think the next slide here be able to show some of the comparisons between the two, but we're able to shave off over $300 million in capex by developing this as an underground only mine. We believe permitting is a lot easier and more straightforward to develop it as an underground. And the bottom line economics are significantly stronger as an underground only. And I will say too that I think from a local and First Nations and other stakeholders and rights holders perspective, the consensus is they'd rather see an underground mine developed up in that area. I think they'd be supportive of your project if it's an open pit or underground, but the preference is certainly to see this as an underground. And so we take that pretty serious as well, because those opinions are very relevant and have to be taken into consideration as we move forward through the environmental assessment period of which we're about to enter. So looking at some of the key metrics that we determined from our pre-feasibility, I think one of the standouts here is that this will be a very low cost operator. I mean, we're looking at US just over $7 a pound, $7.18. So don't know what the conversion is now with the Canadian dollar, but we're looking at an extremely low cost operator. And as I mentioned, we're able to shave off 300 million as compared to an open pit scenario. So capex will be about 1.2 billion dollars. Very quick payback. It's about a 3-year construction period to get the mine up and running, but a payback period of just over 2 years. So, and that's because you're mining very high grade ore, very valuable rock, very close to surface and quickly. So it has a quick payback. So high capex, but very quick payback as well. So looking at some of the timelines that we're after, we're entering in what we call the EA, the environmental assessment period. That would go from where we are now, completing the pre-feasibility, going through the environmental impact assessment, which will take us probably a good 3 years. So we want to complete our feasibility, which we'll be able to undertake shortly, and then get going on a lot of the permitting aspects as well. So we look at a timeline about 4 years out from now, we would be in a position where we would have gone through the full review and consultation package and be able to receive permits to build. So you're looking at being a potential producing asset by around 2027. We've completed our baseline environmental studies. There's a little bit of ongoing monitoring to be done, but basically it is complete. And and we're also continually committing to the northern communities and the economy. This is a project that's looked at very favorable by people up in the north. They want something to be developed there. We have the asset that has that ability. Lastly, this is just some corporate information. You may have noticed in the news release we put out yesterday, we have raised a credit facility for $10 million US. So now our cash in the treasury is about $18 million. And, that's enough for us to be able to go forward, move forward, progressing this project towards feasibility. Get started on the feasibility, work on the permitting side for the EIS, move forward, and to be able to take advantage in this great upswing that we're starting to see in the uranium market. So Fission is a very relevant player, and I think I'll leave it there for some Q&A. Hopefully that gives you a little bit of a summary of the project itself.
Great, thanks, Ross. Yeah, let's we'll go to some questions from the line. On that, I guess maybe talking a little bit about the use of proceeds on that $10 million credit facility. Is that just going to be for the EA and feasibility study work you're planning to do, or are you also going to potentially do some drilling with that money?
Yeah, well, I guess the first bit of that is there's really no work to be done right now at the moment. I think that's probably true for most companies. We do have a plan in place. You can't act on it, obviously, and that's a function of the whole shutdown and the ability to do any work in the field, but due to the coronavirus. However, we have a plan that basically gets started on our feasibility studies. There's some field work to be done that we would hopefully be able to get to this summer. It may be pushed back till September. And that's some field work that's designed around the feasibility. So we plan on advancing this as a underground. So we need to do some drilling along the decline. We'll do some test holes for the freezing. There's a layer of freeze holes that go at the bottom of the overburden to the bedrock interface. So we want to get some studies done on there. So there is a little bit of field work to be done. There's the actual feasibility study that it's all part and parcel of the same thing, but that's the overall report. So I think we'll be able to kind of advance on all levels. We're going to be very mindful, even at the amount of money that we have right now. We're going to need, that'll get us through probably the next 3 to 4 years, and then we'll still have to do a bit more work after that. But I think what it does is it gets us the ability to start moving again, and that's really where we want to be in this uranium market that's starting to uptick. We want this project to be up and ready for when we truly do see a significant increase in the price of uranium, as you've outlined earlier.
Yeah. Now, with respect, still on the on the facility, obviously the warrants, the warrants that came with the facility as part of the interest were priced. Well, at yesterday's close, they were priced in the money, but obviously that probably got negotiated before. Can you maybe give a little color on the pricing of those warrants and how that how that price got arrived at?
I certainly can, and you're absolutely right. They were not in the money when we were negotiating the deal at all. The uptick, and it kind of happened for all companies, so it was nothing just specific only, or sorry, to Fission only. We moved up from about 13, 14 cents very quickly to 25 cents. So they weren't in the money, and this deal's been negotiated for the last several months, and the prices have probably been agreed to around 2 to 3 weeks ago. You know what? But I think that the upside on the warrants is that they do, if they're in the money, they get cash. That's a financing right there. That gives us even more funds to be able to go forward with. So that's a built-in financing if the share price performs well and those warrants are exercised. So that is a significant win for us as well. So the facility that we did raise is a non-dilutive sense, but the warrants obviously would be a dilutive event, but they do give us cash. Both elements give us cash, and that's really what we need in order to move the project forward.
Right. Yeah. And then just one of the last questions is on on cost control measures. Obviously, that's something that's first and foremost, up until a week ago, no one in the uranium market, money was hard to come by, and hence the credit facility financing. What has Fission been doing to sort of control its costs and get things under control?
Well, we've been undertaking this, for a long time, actually, probably since about last October, when we really started to cut back on a lot of expenses. So well before the markets, took the unpredictable volatility moves that they have been doing in the last couple of months. But we've really reduced our, number one, I've reduced the staff. We don't need a lot of people. There's no field work going on, so I've had to, unfortunately, reduce staff there. We've reduced our IR and our IR spending, public relations spending, business development. Basically, every category has gone through and taken significant reductions, and we're not done. We call that phase one of cost reductions. We know we have a great deal more to do. We plan to be streamlined. Yes, we have a little bit more money in the bank right now, but that does not mean we take our eye off of those cost-cutting measures. We know that that's extremely important. We want to be able to get through the next several years as a very viable entity, and so we're not done with the cost savings. But those would be some of the areas obviously that we have been working to cut in the last few months.
Okay, I think with that and that focus on getting money into the ground to keep the project moving forward, we'll leave it there. And then if there are a couple extra questions, we might deal with those at the end when we talk about the uranium market. With that, we'll move on to our next presenter, which is Daniel Major, CEO of VX Uranium. If Josh can flip up Daniel's slides, we'll be ready to go.
Thanks, Derek. I appreciate it. Thanks for that nice intro on the market. You've done most of the work for us already, so that makes life a little bit easier. So I'll take you through GoVX. It is a very different one. I think it's a very exciting company from where it's coming from. There are disclaimers. There's on the website, the presentation as well, so you can find them there. GoVX is all about becoming a developer. The company started in 2007. We put a substantial amount of work into exploration between 2007 2012, put a very large resource base down. On the back of that, the board then decided to de-risk it and get this project moving towards permitting, getting it ready for development. And that really has been what we've been doing, even in these quiet times. So we went ahead, got our mining licenses. That's one of the key benefits of being in Africa. So particularly the Madaouela project that was achieved within 6 months. We cleaned up our balance sheet, took a substantial debt off our balance sheet as well that was leveraged to the uranium price and had security on our assets. So we've got a nice clean balance sheet. And then we started to do transactions as well. We acquired the Matanga project. It was already permitted as well and ready to go. And the Falea project in Mali. So at the moment, the focus is very much on getting the Madaouela project in Niger ready for development. We are only in Africa. We think it's a great jurisdiction to be in. Niger particularly has been a long-running developer for uranium, producing well over 140,000 tons of uranium since the early 1970s. That was all produced by Areva, now Orano. 60 to 70% of the country's exports annually is uranium. So we get a lot of support from the government. The key to this as well is that the Cominac mine, which is next door to us, is due to close, or one of Areva's mines, next year in March. That will be about £3 million removed from the market permanently as it comes to its end of life of mine. And then within 5 to 10 years, the Somalia mine, also owned by Areva, will also go into closure. We have relatively stable governments, and we have a very good business law that encapsulates most of West Africa. Just briefly, I'll touch this. This is the supply-demand one. We're looking at this good, solid growth, but as we've just been highlighted by Derek, we've got this decline in supply going forward. It needs new supply. It needs price to drive it. And that's where GoVX has really positioned itself, is we've gone out and focused on getting our projects ready for development. We're not waiting in this cycle now to be able to start construction other than the final price that we need on these projects. What we've done is got them permitted. We're focused on getting the projects the best we can and then take them into construction. So if this price continues to be supported going forward, as we're seeing, GoVX can react very quickly to it. So we start with the Madaouela project. We own 80% of this project. The other 20% is owned by the Nigerian government. It is really well situated in the middle of the Sahara Desert, next to the two towns of Arlit and Akokan. They are both owned by Orano. They were built in the early 1970s. So power is there, road is there. Surprising for most people, there is a lot of water. 40 meters below the surface, we hit water. But importantly for us as well, going into construction, planning to go into construction, we have a labor force at Cominac that will be looking for work. And that is why we get a lot of support from the government as well, who are keen for that labor force to find work going forward. So last year, we were able to do a deal with the Nigerian government. We were able to take off our balance sheet $14.5 million that were owed to them for initial acquisition fees, license fees. And the government took that in exchange for a 10% equity stake in the project, effectively valuing Madaouela at $145 million. We currently have been working with banks and various off-takers. That slowed down as the market was getting quiet, but we continue to engage with them strongly, and they're currently effectively waiting for our updated PFS. We did the last PFS back in 2015. It showed a $360 million to produce just under 3 million pounds per annum at a cash cost of $24 a pound. But what we did at the end of 2018 was to really sit down and go, all right, Cominac has come out, Cigar Lake and MacArthur River, CCO was saying they needed $50 to restart MacArthur River. So we looked at our property and said, right, well, this property has got to be as good as MacArthur River. If they restart that, then the Kazakhs will relook at their opportunity. And so therefore we have to make sure this project does the same thing. So we've been looking at making Madahuela bankable, not just a great PFS, it has to be bankable. We've been looking at the type of technology that we use to make that fully bankable, reducing our operating costs, reducing our capital costs, making sure that the payback suits what the banks require, making sure that the extension of reserves beyond that repayment works as well. So we're working very closely with the banks to make sure that we're not just producing a great PFS and then a great FS, we're making sure that this is a bankable product. We announced recently there may be a slight delay. We're initially expecting that May would be our date. This does not mean we've stopped the PFS at all. We were waiting for some test work to be completed in South Africa. Unfortunately, last week, South Africa went into a 3-week lockdown. So what we've continued to do is make assumptions based on the original test work that we did. We're continuing to move the PFS forward in all areas, including the metallurgical design. We're sending out RFPs for various parts of the design process to be costed. We've had quotations from 6 different mining contractors that we could now put into the mine design. So we're still full on working on that initial PFS. We did a PFS as part of the FS because we've made so many changes to this project, all to the betterment to get us lower capital, lower OPEX, to make sure that given where we're seeing the commodity moving, we want GoVX to be up and producing at Madahuela as quickly as possible because we have that mining permit. The other advantage we have is we don't just have a single project, we have multiple projects. So we also have Matanga. Matanga is a very straightforward open pit heap leach operation in Zambia. We own 100% of it. We have a lot of exploration upside here, it's the same as we have at Madahuela. We haven't been drilling on either property because we already have long life projects here. In the case of Madahuela, 21 years. In the case of Matanga, well over 11 years. But we can expand these through further exploration. We also have the Falea property that is sitting in Mali. It's a very interesting one with some interesting silver and copper credits that go with it. Matanga, it's $120 million to build. It's a third the capital for almost the same production rate that we'd get out of Madahuela, but it has a slightly higher operating case, and that's why we tend to focus very much on Madahuela. It's about getting our cornerstone property into play in the rising commodity price. That underpins the company going forward. Matanga gives us that flexibility that if the price continues to run, we are able to bring in a second project in our pipeline. We have a management team that have been in this industry for a very long time. In development, in banking, in exploration, consultancy as well. Our board as well has a lot of experience bringing in different facets, both technical, West Africa, debt, the uranium industry. So we have a well-balanced board going out there. We've had strong sponsors here as well in the case of Denison, Cameco, Ivanhoe Industries. We have just before the market collapse raised money, so we're well situated. We have cut a lot of our costs back, and even a long time ago, all of our management took substantial salary cuts and maintained those cuts all the way through this market. So we're well positioned to go forward. We're very focused on this PFS. That's the key for us. Get that out of the way so we can go back to the banks, show them where we've made the major changes to this project, and keep moving that forward to that feasibility study to get it completed, because we do believe in the fundamentals of this market. And GoVX is all about being able to leverage up. In the last cycle, and I often mention this in presentations, the key drivers are about re-rating. All uranium companies will go up in this cycle, as we're seeing already. But how do you differentiate yourself? You can differentiate yourself by going from being a developer to being a producer. And in the last big cycle, you had Paladin and Energy Fuels outperform the whole sector by a large amount. The difference, they were the only two companies that were able to go from being a developer to being a producer in that cycle. Everybody else stayed in their box where they were. So for us, because we've got these permits, because we're looking at bringing these costs down, we really see that opportunity. early in this cycle for GoVX to go from being a developer to being a producer and get that additional re-rate that comes with that message. So just to finish off, experience management, we've got a very large resource. We've got a great project sitting there. We're really focused on bringing down our costs on this property and making it work at a much lower forecast than we were originally forecasting in our initial PFS. So, and everything is there, infrastructure side to where we go. So thank you very much.
Thank you, Daniel. We will go to some questions now. Perhaps we'll start with talking about infrastructure, and this is one that's probably important for people to know. One of the other mines that operate in Nigeria is Cominac by Orano, and that mine is shutting down. I guess next year it's scheduled to shut down. Maybe is there any positives or negatives for GoVX on that particular shutdown?
I think the two driving positives that come out of this, one obviously is political. The government is very keen not to see a large amount of unemployment in the north, and is very keen, therefore, for GoVX to be up and producing, and to take on that labor and ensure that unemployment. Niger, as well, as I pointed out, 60 to 70% of its exports is uranium. So if you're losing one of the two mines, a lot of its exports are about to disappear, and its tax revenue. So again, very keen to get GoVX up and producing. And for us, one of the issues that you always have in various development jurisdictions is, where do you get trained labor from? We're sitting with a whole labor force that's been operating on a mine that's been running since the 1970s. They know how to mine in uranium and understand uranium safety and radiation safety, which is very hard to find in any other jurisdiction.
Yeah, that's good. The question from the line: how long can you continue to run the company with the cash on hand and at the current uranium price? And what measures do you take to maintain the company's ability to act or to ensure you have adequate financing? So maybe talk.
Yeah, obviously we did the placement, or we got the first tranche away at a premium to the market. It was a substantial premium to the market when we did that. We've cut a lot of our work we're doing in the field, particularly. We are benefiting from Corona as well. Actually keeps everybody at home, so everybody's a lot quieter from that point of view. We'd already cut a lot of our costs out of here. So very much the focus for us is getting that PFS. What we don't want to do is sit here and have no results at the end of this process. So we're still very much targeting to try and get this PFS out by the end of Q1. If this market is benefiting, we need to still come out of the other end of this lockdown and show that we've moved forward. So we're good on cash until sort of the beginning of the second half of the year from where we are. We only raised enough to keep us going, which is what we've always done. We believe where this market is going. So we're good where we stand.
Okay. And this is a question a little bit from the past. When you originally the properties that are in GoVX got vended from Semifo, does Semifo, or I guess now Endeavour Mining, still own those shares, or are those out in the market, have since been sold?
As far as I know, Semifo was still holding their shares. The last time I spoke to Semifo, I think it was 10 million shares they were holding.
Okay. All right. And I guess, have you talked to your new shareholder then, or Endeavour, or soon?
Not yet. Not yet.
And then this is a question about directly about Cominac. Can you speak a little about the state of Orano's mill and your views on the pros and cons of using it or versus building one yourself?
Yeah, I often get asked this one. We had conversations a long time ago with Orano, or Riva when they were at the time, on Cominac. And in fact, in 2013, we did 14 different analyses of plant design, and one of them actually was the Cominac plant design. It's very expensive to operate. It is very acid consumptive. They consume about 120 to 150 kilograms of acid for every ton of rock that goes through that plant. They heat it up as well, and so it is very costly to operate. We have been talking to Cominac, obviously, about that plant. Their view and the way they're positioning themselves is the shareholders of Cominac have decided to take that plant and take it to the ground. They want to completely rehabilitate it. Our view as well is that based on bringing new ideas in, I mean, you've got to remember that thing was built 50 years ago. We can bring in our costs a lot lower than Cominac can operate at as well, which allows us to also be able to talk to other parties in the region and say, well, you know, why don't you talk to us about low cost processing?
Right. Yeah, a new modern infrastructure and the benefits outweigh the
oh, absolutely.
Yeah.
It's a very, very old plant and very expensive to operate.
So, okay. With that, Daniel, I think we'll leave it here on questions and move on to our next presenter. Thank you.
Thank you.
Moving to our next presenter is Corey Diaz, CEO of Anfield Energy. Corey, go ahead.
Thanks, Daniel. Appreciate the introduction. Good job, everybody else who's talked so far. Anfield is sorry, technical difficulties here. Just trying to shift this. There we go. There's safe harbor. You can read at your leisure. Sorry, Derek, I can't move the slides. I'm looking for, here we go. Good, thank you. All right, so reason to invest in Anfield. Anfield operates in the US, has assets in the premier mining jurisdictions in the country, Wyoming and Utah. It has multiple substantial deposits submitted with ISR. We have 25 projects in the ISR space in Wyoming. We have access to existing processing infrastructure. Uranium One has its facilities in Wyoming, which is perfect for us. We're in close proximity. Low permitting risk, obviously, in the US. We also have low expected capital costs. We did put out a PA for our flagship property, Charlie, in September. We'll talk about it a bit later. Long-term optionality in our portfolio. We have both ISR and conventional assets, including the Shooting Canyon Mill, which is one of only 3 licensed, permitted, and constructed mills in the United States. And we have a highly experienced management team and board. If you look to the right of the slide, we have a portfolio of 25 ISR properties in Wyoming. Charlie is a flagship property, which is adjacent to Uranium One's existing processing facilities. We have an agreement in place, a resin capture and processing agreement with Uranium One to process up to 500,000 pounds per year. The PA on Charlie was completed in October 2019. And we have the Shooting Canyon Mill with multiple nearby uranium deposits ready to feed that mill should the price move up significantly. Anfield's strategy is twofold. It wants to create 2 mine and mill complexes, one in the ISR space and one in the conventional uranium space. The ISR mine and mill complex is going to be based in Wyoming. Wyoming is the leading area of ISR production in the United States at the moment. Charlie, given its proximity to Uranium One's existing mines, means that we can get that into production relatively quickly. From the other 24 projects that we hold in Wyoming, we'd look to create a pipeline of projects that could lead, create this pipeline that could follow on from Charlie once Charlie is depleted. If the uranium price moves up significantly, we'd look to our Hardrock assets, such as Shooting, and look to refurbish that mill because there's a cost of roughly $30 to $40 million in order to move that forward. So finally, as I said, we'd like to be able to move forward into production in the near term on the ISR side of the market, and then in longer term, blue sky on the conventional side. Potential near-term industry catalyst for us, especially as a company operating in the United States. We've had uranium reserve and working group recommendations. Back in January, the U.S. government budget proposal included the creation of our uranium reserve, about $150 million per year for 10 years, which means that companies such as ours, which have a near-term path to production, could be considered for long-term sales contracts with the government. So that's obviously a positive. That's a very small group of potential contributors to that uranium reserve, so we're in a good position to benefit. And the government also said that not only is it going to put together this uranium reserve, but it will also provide us with a number of other opportunities to revive the uranium market. So we're looking forward to seeing some of those recommendations. And some of those will be driven by the Nuclear Fuels Working Group recommendations or report that's sitting on the desk of the president at the moment. In that study that was put together in order for the government to understand the entire nuclear supply chain, there's some recommendations that we think are likely to come out of the report, including financial incentives to either uranium producers or utilities or both, regulatory incentives such as the streamlining of licensing and permitting, reduction of land holding costs, royalties, government royalties, and market creation incentives, which I think you can see come out in the budget proposal that was put together by the Trump administration. I think for us, the timing is the big question now. Obviously, coronavirus has had an impact on the release of the recommendations. We're hopeful that we'll see some recommendations in the next 60 to 90 days. But in any case, I think that we've seen some positive steps, and there's a commitment from the administration to see a revival in the U.S. uranium market. Capital markets profile, we have about 83 million shares outstanding. Market cap is just under $6 million Canadian. Our largest shareholder is Cotter Corporation as a result of the transaction we completed with Cotter back in 2019 for both the Charlie assets and the West Slope properties in Colorado. And we have research coverage from Derek. Management directors, I've been the CEO for about 7 years at Anfield. We have significant sales and marketing experience on our board, including Don Falconer, who's worked in the industry, both corporate issuer side as a CEO and worked for Ontario Hydro in the nuclear division in sales and marketing. Steve Lunsford is another person who spent 40 years in the uranium space working for Cameco and actually has direct experience with our Charlie property. And Scott Lloyd, who has done sales and marketing for us for the past couple of years and has experience both working for a utility and for a trading company related to uranium. So we do have a fair number of people with experience on our board. Our steps to uranium production. Our focus in the near term is the Charlie project, just because of its proximity to infrastructure and the low cost opportunity that it does present. We did put out a PEA which called for a pre-production cost of $6.7 million. And we have a resin capture and processing agreement in place with Uranium One, which allows us to produce 500,000 pounds per year at its existing facility. In the medium term, as I mentioned, we have 24 other projects in Wyoming, which are ISR related. We would look to create a pipeline from those projects. There's about 30 million pounds of historic resource there. We'll continue to create resource reports and look at the most viable handful of those projects to create a pipeline of 10 to 50 million pounds that can follow on from Charlie in Wyoming. And then assuming the uranium price continues to move up significantly higher, we'd love to see the blue sky of the conventional uranium mill realized through the refurbishment of Charlie, which could add another 1 million pounds of production capacity to our portfolio. So between Charlie, the resin capture agreement with Uranium One and the Shooting Canyon mill, we'd have about 1.5 million pounds of production capacity available to us. Here's a map of the Saskatchewan, but our focus is in the United States and specifically with Charlie. You can see that we have 25 projects up in Wyoming. Some of the resources are shown on the screen. The conventional assets include the mill, 4 royalties on projects held by 3 of our competitors, and we have properties such as the Velvet Wood, which is our flagship conventional asset in Utah. So the Charlie project, as I mentioned, we've picked it up from Hardrock Corporation last year. So at 24 months to get the asset into production. We have an exploration target on that property. We have 4 million pounds of resource currently, but we can actually increase that by another 400 to 800,000 pounds. The PEA called for about a $19 million NPV at $65 a pound, a pre-production capex of $6.7 million, and direct OPEX of about $23 per pound over the life of mine. Here's a map of our other ISR projects. These are projects that we picked up from Uranium One back in 2016. Just to mention, we've closed 2 transactions with Uranium One, and we've closed 1 transaction with Hardrock Corporation, so both much larger organizations than ourselves. But we've been able to negotiate with them and complete significant transactions with both companies in order to grow our portfolio. But you can see we've got resource reports for a handful of the projects. Our aim as we go forward is to continue to put 43-101 compliant resources to the projects that we did acquire. Obviously, the cost could be prohibitive, but we're going to be selective as we go forward. The Velvet Wood project, as I mentioned, this is our flagship conventional asset. We purchased this from Uranium One back in 2015 as part of the Shooter Canyon mill transaction. We did put a PA out on the project back in 2016 with an NPV of about $63 million. This would likely be the first feed into the mill once we have the mill refurbished and up and running. Other assets that we hold on the Hardrock side include the Frankham deposit, which is right next to our mill, the West Slope project, which was part of the Cotter transaction. This includes about 11 million pounds of uranium and about 53 million pounds of vanadium. Our aim is to have that material shipped to the Shooter mill should we get that up and running. There are other options that we could use in order to realize the value there, but I think in longer term, we'd be looking at that as a significant feed for the mill to create a significant life of mine for Shooter. We do have the filling tank pressure pipe in Arizona, and as I mentioned, the royalties on the assets of 3 of our competitors. Peer comparison, as you can see, even from Derek's previous snapshot, our stock has been beaten up pretty significantly over the past year or so. We're trading well below our peers. We do believe that our portfolio of assets doesn't justify such a low valuation. We certainly do think that with news coming out of the administration in the U.S., whether it's the Uranium Reserve or the working group, we should see a re-rating in our position. We do think that as we move Charlie forward, that'll certainly give us a near-term opportunity to create real value as the market improves. And finally, as I mentioned, our aim here is to get into production in the near term. We have both ISR and conventional opportunities. ISR is the place where we'll start, and specifically Charlie. Our proximity to Uranium One and its facilities is a great boon for us because it means that we don't have to spend money on building satellite plants or final processing plants. The agreement that we have in place is a long-term agreement which allows us to produce 500,000 pounds per year. I think as you see the market continue to see supply declines, it creates an opportunity for companies like ours to step in and fill some of that gap. But I think it's going to take a little bit more time for the market to really realize and substantiate what has taken place when it comes to Cameco, Kazatomprom, and other parties and their decline in production. But we do think that we're ready for any upside that does come out of the current market conditions. And that's it. Derek?
Great, Corey. Thank you for that. I guess you're talking a little bit about share price performance there at the end, and this leans into that. One of the questions from the audience is Anfield shares have underperformed relative to some of its peers over the last few weeks. What steps are you taking to sort of change that, or what do you think's caused it?
Well, I think there are a couple of things. I think the first thing is we are currently in a financing, in this pretty weak environment, and we did manage to close in the first tranche of the financing, about $1 million financing. We closed $400,000 in late February. But we are aiming to close the second tranche, the final tranche, next week. So I think that once we're able to close the financing, I think there'll be an ability for the price to start moving again, because I think the stock is traded relatively in line with the maximum discount associated with the financing that we're doing.
Right. And then with that, one of the questions was on sort of the company's G&A and cash burn, but also how much is the existing bond on the properties that's due this year for Anfield?
Sorry, the existing bond?
Yeah.
But we have. Sorry, go ahead.
Yeah, the question was specifically how much is the existing bond on the properties that is due this year? That was the question.
Well, we have a bond in place with Uranium One. It's a $7.1 million bond, and that's not due until next year. Okay. So this year we have strict land holding costs, et cetera, but not bond related.
Okay. And then I guess maybe talk a little bit about what your the question was about G&A and cash burn.
Our cash position, we're about a little over $150,000 today. Our cash burn is roughly $50,000, $60,000 per month. So as I mentioned, we still have an open financing. So, we're aiming to get that closed in the next week or so, which would provide us with enough cash to carry us through the rest of this year. Right.
And maybe talk a little bit about how the strategic reserve or the nuclear fuel working group is going to directly benefit Anfield. Do you think this will help get some of your, not just your ISR assets, but your conventional assets into production a little bit quicker?
I think this would probably just strictly affect our ISR assets. I think the price, the implied value, I'd say, would be 2.5 to 3 million pounds of material. And that's probably priced, an implied price of about $50 to $60 per pound. And that's probably not high enough for us to look to turn on the conventional mill. I think, given the size of the need, I think that, splitting that amongst 5 or 6 potential producers means that, Anfield's contribution would probably be on a smaller scale. So I think that this would strictly affect our ISR business.
Okay. All right, and then on Charlie, obviously with having the partnership with Uranium One helps. How quickly do you think you could be in production, assuming that you had the money and a uranium price that made sense for you?
It'll be a 2-year process. We've got the PEA. We call that a 2-year pre-production process, and then we'd be in production.
Okay, good. So a short timeline to hit this cycle. Good.
That's right.
I think with that, we'll leave it there on Anfield specific questions, and maybe open it up to some market specific questions, or some general questions that we've got for the whole audience, or for the whole group. In particular, I think one of the questions for all 3 presenters, and actually Corey just answered it on G&A, was what's your annual G&A, and what are your annual G&A costs?
I'll go first. We're looking currently. We're about 300,000 a month. Our target is to get down to around 2, and I think we'll easily achieve that. Part of that G&A is also, there is some minimal cost involved with keeping PLS on care and maintenance. It isn't, we can't just leave it behind. So there's a fair amount of inventory up there. There's millions of dollars worth of core. It's a secured radioactive area, so it requires security, 24/7 security and that. So, we've the camp is quiet, but it's not completely absent, and there are certain obligations that we have to keep it going. So that's probably that's maybe a third to almost a half of the G&A right there, and the rest is we're continuing to trim and look for ways to, but we will continue to bring down our costs. That's about what we're working.
Okay.
Ours is 3 million a year, roughly. That includes all our license fees. That includes all our CSR costs. That includes all our listing fees, everything, and the continued field work that we do, because we just encapsulate it all into one thing.
Right. And Corey, you just answered that question.
Right.
So, and then we've got a question from the line on, and this it's electricity demand is declining, obviously, with the global downturn. How does this affect the demand side of the fundamental story? So, for nuclear reactors and how they operate within the grid are typically baseload production, so they operate fairly steady. If one of my past jobs actually bought power for a steel mill, and the reactors set up that base load, and then the other sources like gas or coal or hydro, in the case of Ontario, they all fluctuate depending on demand. And so the expectation is, while those areas that those ones that fluctuate will come off, and that the uranium demand would be relatively steady. So that's why these shutdowns are such a big deal in the fundamental story. It just literally takes supply out of a balanced market.
On that, what you're seeing is that overall energy is down. It's been tended to be taken from things like coal. Where you have seen areas that guys have got plants already down, particularly in France, for example, they're just delaying bringing those nuclear plants back online again. So there will be some reduction in total energy generation, but I was talking to a trader today. He's seeing the same demands coming back for people who know they've got reloads coming and are still preparing those reloads. And in fact, in some cases, some of those reloads are now being pushed out because they can't do the reload because of COVID-19. So I don't think you're going to see a lot of impact on the actual physical uranium demand that's going into the demand side. And in fact, the supply side shock that we've seen coming through is far greater than anything we're seeing on a reduction in power on the demand side. So expect some power down, but in reality, the supply side shock is far greater.
Yeah, actually, this is a time of year that most of the Ontario nuclear plants do their annual maintenance because you have higher hydropower because the flooding. So yeah, I don't think any of those plans, those reactors are continuing to tick along. Another question on the potential of a slowdown in construction of nuclear power plants because of COVID-19. Nuclear power plants take years to build, so a few month on the slowdown side, a few month slowdown on the construction side, I don't think it's going to affect that materially. I guess like every question with COVID-19, it comes back to duration. If we start looking at 6 months of restrictions, I think that'll be a big.
The Chinese have already restarted their construction of full on. So the work that they were doing, they kept their critical team still working. But I was reading something even yesterday that they're now fully loaded construction teams back up and running again. And even the ones in the US have tried to keep going the best that they can. So, you have very large workforces. You do not want to be paying them to stand and do nothing. Even here in the UK, Hinkley Point construction has carried on all the way through. They've just slowed down the number of people on site to reduce the rate, but construction carries on.
Yeah. This is an interesting question. Is there no fuel substitution possible for reactors? I guess variations on the combination.
No.
I think, that's
No.
These are very and trying to get that through a regulator might be even harder. So that's certainly one that isn't going to happen. With that, I think that takes care of all our questions on the market in general. But maybe, Corey, I'll throw it over to you for a second on the nuclear fuel working group, because obviously that directly affects your projects. What have you been hearing from? What have you been hearing on that?
Well, it was interesting early in the year. There's a lot of momentum building towards the release of the recommendations related to the working group's report. It's so much so that in early March, scuttlebutt coming out of the DOE was that the report was coming out within a day or two, and then obviously the concerns around coronavirus grew significantly, and I think that impacted the release date of the information. And right now it's moved from the top of the pile probably down to the bottom of the pile. Unsurprisingly, there's obviously much more concern related to coronavirus than to what happens with the uranium sector at the moment. But we're still cautiously optimistic. There have been a lot of comments out of the Secretary of Energy or other government officials who said, look, we need to make sure that we do have security of supply given everything that's happening in the world. Not being able to get items from overseas due to coronavirus, the fact that Russia and the Saudis are having a negative effect on the shale industry in the U.S. These are all things which are making the U.S. government rethink or reemphasize the need for security of supply of uranium in the U.S. So that bodes well for us. And we've also had a couple of our peers push to get the uranium reserve started earlier than expected, through the Defense Production Act, which it does show that there are parties who are lobbying hard to get something done in the uranium space relatively quickly, regardless of when the report is actually released.
Okay. And then a question on the long-term contracts and demand for 2022 that I mentioned in my slide on the uncovered demand. And so effectively, uncovered demand is effectively is uranium that utilities haven't bought yet, for lack of a better term, haven't contracted yet. And so that it always goes up over time. That chart looks the same basically as you move it along. The components are what matters and why it stood out to me on this report. Now, and when a utility signs a new long-term contract, whether it's from one of these guys when they're up and running, or a Cameco, they won't expect to get uranium for 2 years. It's a typical cycle on the delivery. They tend to be longer term, 5 to 10 year contracts with price escalators built into them, versus the spot market, which is what everyone's been talking about in the price move. And those for the U.S. to have 17 million pounds of uncovered demand this close is very unusual. And the fact that it's at a time when they have to be contracting now to get there, in a time when the supply deficit that we're seeing this year it's growing is actually going to continue to grow as we go out beyond here, because with the exception of Kazatomprom, almost every mine in the world is uneconomic at the current uranium price. So that's what's happening. So, I don't know if you guys have anything to add on that vein.
I think the one thing you did see though was and the Section 232 caused it, so you've got to counter that in as well, is that there was a lot of buying of end product. So a lot of buying of EUP, UF6 particularly, which shortens that timeline considerably. So you can take a year out for UF6 and take out down to 6 months for EUP. Yeah. So guys were able to shorten their timeline and not knowing where material was going to come from, if there was anything coming out of Section 232. But I think the other thing has been for all of us is that, at the end of the day, there's a balance between the carry trade on the spot market and the long-term price. And so what you are going to see with this recent move is that now starting to filter into that long-term pricing. It needed the spot price to move to be able to start to move the term contract price, because there is that carry. You could borrow material now, hold it in stock, lease it, and sometime in the future you had a price. If that was always lower than the contract price, then you just took spot material on carry. Now that spot price has moved considerably closer and closed that gap on that term contract, we can expect to start to see signs of that term contract moving.
Yeah. I guess the question on those midterm carry trade deals, do you expect them to continue in the new price environment?
I think there's always going to be that part of the process. Different buyers buy different material in different ways. They're no different in trying to diversify their buying, who they buy from. They also diversify the way that they buy material. They will take some in on spot, they will take some in contract, and some, will take on these sort of shorter term carry trades. Again, are you buying just U3A, or are you picking up UF6 or EUP? There's a balance here because you're trying to protect your risks as a utility at the back end. But I think what you haven't seen, which the market was predicting early on, was the end of term contracting. That's very much still where this market is going to stay.
Yeah. The last or one more question there, and this is something the news that was announced this morning on the Cameco announced shutdown of Port Hope in the conversion facility there. Do you guys see any, other than the impact that you just talked about on the high end of the market? Do you guys see any other impact?
There is one issue, which is UF6 was getting really tight. Anyway, I mean, we'd seen Convidine earlier in the year, just when it shut down, Metropolis had mopped up all the UF6 that it could find, and had been using that to meet its contract. So if you've now started to see other conversion facilities shutting down for any material of time, you're going to have a bit of a problem in the middle of the pipeline. So where it was tight anyway. So expect that UF6 price to move definitely. And that should probably be good for us, because then people are going to have to get U3O8 back into the supply system, and they're going to need that U3O8. So expect it to have a good positive effect back onto U3O8, probably quicker than you saw from the previous conversion price move.
Yeah, with the supply deficits. And then I think that's a good overview on the market and what we've done. I've still got a fairly sizable audience on the line after an hour and 15 minutes. But I think we'll leave it here. The last question is, and I think this is a good one, to the three of you on the line, which of you are buying your own shares at these prices?
I can answer mine very quickly. We're in lockout. We're in blackout, and have been since the beginning of the year for various reasons. So we're not allowed to buy when we're doing a raise, when we have material announcements, and when we've got our accounts. So unless you put your accounts out, you're blacked out.
Yeah.
I would have liked to. I was set up to do it.
We're in exactly the same position. We just, we've been working through a deal for a couple of months now. And we just haven't been able to. And when I saw our stock below 10 cents or 10, 11 cents, I would have felt absolutely so much. Still would. I think we're still very undervalued.
Yeah, and I think the same here. I've actually participated in the first tranche of our financing, so I can say I've already put money to work in our stock, and I think we're very undervalued, as I showed in the slide. And I think that as I said, I think our stock is holding where it is because of our financing. I think once the financing is done, we'll see some lift.
Okay, and with that, we'll leave it there. I'll wrap up this webinar. I want to thank everybody, the companies, for presenting, the 150 people or so that we had on the line for the duration of this, for most of this webinar. It's what makes the presenters and the attendees and what makes this work. So thank you, everybody, for participating. This is only our second virtual webinar that we've done, or virtual conference that we've done. So if people have feedback on it, please reach out to us and let us know. Looking ahead for us, tomorrow I'm hosting a webinar with Platinum Group Metals at 2 p.m. Eastern Time, so I hope to see everyone there. And then next Tuesday, we've rescheduled our Where Does the Gold Trade Stand webinar on Tuesday, April 14th. So those are a couple of events to look forward to for us. And to stay up to date on all of our current webinars, the replay from this webinar, and our and those that are in the pipeline, make sure to check out our news and media page. I'm sure Josh could put that up at the end in the chat for everybody to see. Thank you very much, and everyone stay safe, and we'll talk to you soon.
Thank you.
Thank you. Bye-bye.
Bye-bye.